This week, retirees face the consequences of a manufactured recession. Welcome back to the Industry Leader Update. The Federal Reserve may have been caught flat-footed, at least it seems so, while inflation made a historic run in the spring and summer of this year. In response, the central bank enacted numerous interest rate hikes, all in the effort to help cool the economy. And the Fed has also signaled its willingness to push our economy into a recession if necessary. Now, despite 2 quarters of negative GDP output, some are still dithering over the definition of a recession. And others are expressing concern as to just how much monetary contraction a supposedly healthy economy can bear, while the federal government continues to accelerate its spending and fighting the Fed's effort to curb inflation. However, what few are openly discussing are the real-life impacts of the Federal Reserve's policy shift and those impacts on older Americans who are retired or on a fixed income. Now, in today's rising interest rate environment, one of the most vulnerable cohorts of older Americans are those who are carrying substantial credit card debt. Now consider the following. With the average credit card charging a 24% APR, even a modest balance of $3,000 will require a monthly minimum payment of approximately $95, of which $65 or 68% is just merely paying the interest. It would take 16 years to pay off the total balance for one only making the monthly minimum payment. And during that time, they will have incurred over $8,000 in interest charges. Now, those wishing to reduce or eliminate interest charges on a credit card have a number of choices. They can seek a balance transfer to a zero interest rate card during the promotional period, if available, get a part-time job to pay down the balance, enroll in a nonprofit debt management program that renegotiates a lower interest rate, or look to their home's equity for relief. Now, the challenge in using home equity to help pay down credit card debt is today banks are tightening their lending standards for home equity loans. And that should not come as a surprise, considering that home sale prices and home values are dropping as the economy slows. However, there is one loan not subject to a tightening credit market presently as banks seek to reduce their risk exposure. That is the federally insured reverse mortgage or the home equity conversion mortgage. And while many eligible HECM borrowers could have less loan proceeds today to pay off an existing mortgage or credit card, that because of higher interest rates, there are others who may not. Now, as I mentioned on this show last week, many of those who were eligible but chose not to take out the loan in 2019 or 20 may in fact get more money than they would have 2 years ago despite higher interest rates. That thanks to an average 42% increase in home values in 2020 and 21. Now, I'm going to pause for a moment here and remind our viewers that I'm not a financial advisor. I'm a reverse mortgage commentator, trainer, and a passionate supporter of the proper use of reverse mortgages. So, as always, seek the advice of a trusted professional when you consider a reverse mortgage loan. Now, back to our subject. All things considered, retirees are facing a perfect storm of stock market losses, higher interest rates, and the increased cost of living due to historic inflation. And that's going to require a realistic consideration of their debt, monthly payment obligations, and the present value of their assets. Now, thankfully, one asset class has grown faster than the stock market. While the Dow Jones Industrial Average grew by over 25% between 2020 and 2021, many housing markets posted 30 to 40% price growth in the same period. So finding new sources of additional income from employment or utilizing existing assets, those are the likely choices that retirees with modest savings are going to be facing in the coming years. However, while the typical price of home values and equities remain higher than they were just before the pandemic, those values could retreat rapidly. And that's a tragic lesson we've seen played out during the last Great Recession. Now more than ever before, it is the time to present possible solutions to our nation's retirees. They do deserve that. Now, what are your thoughts? Leave your comments in the comment section below. And also, if you'd be so kind as to share this week's video on your social media platforms, we appreciate that. We do have a YouTube channel. You can subscribe. And also, if you click the like button for the efforts we put out each week, that helps us in the YouTube algorithm. Reverse mortgage news, you don't have to read it all the time. In fact, you can listen. We curate the nation's most relevant and breaking reverse mortgage news each and every week on our podcast. That's Heckam World Weekly. Apple users can subscribe and listen on iTunes. That's it for us this week. Be sure to return next Monday for more reverse mortgage news, commentary, and analysis here at Heckam World.